The COVID pandemic has changed our lives in so many ways, including how we approach our investments. The lockdown and the economic uncertainty that presented itself was unique, and no investor really predicted this was going to happen. In this video, I will discuss with you the 3 lessons learned from investing during the pandemic and how these lessons can help anyone out there become a better investor. One of the biggest mistakes that I made during the pandemic was not having enough money to invest. This meant that I missed out on great investment opportunities, and it was really painful. Liquidity risk is the risk of not being able to quickly buy or sell an investment without losing money. As an investor, if you don't have enough money to invest and all your money is tied into things that you can't easily sell for cash, you might miss out on profitable investments, and that was exactly what happened to me. This missed opportunity is what we call opportunity cost. So liquidity risk can lead to missed opportunities and lower investment returns. Many professional investors say that you shouldn't catch a falling knife in the stock market, but I would like to think differently. I would like to say that you should catch as many knives as possible with your wallet so that you can sell it back at a higher price. I do believe that if you have the capital, you should just use it to invest in great companies with good economics so that you can get as much value as possible during bad times and also sell it off during good times. Markets naturally go also up and down anyway, but missing some of the best investment days can greatly impact your returns in the long run. This situation made me really upset. I did a lot of investment research. I believed in the company. I believed that it was really good. They had strong financial reports, strong balance sheets, consistent cash flows, and I understood their business economics. But here's the thing. The real estate sector in the UK was struggling due to various issues. There was little growth in the UK economy. On top of that as well, the pandemic and, unstable governments made things really bad. The supply chain also made it very tough for businesses to operate. Many local businesses had to close down, leading to less money circulating in the economy. If a sector is not growing, it is not a good idea to invest in it, even if the fundamentals of that company are sound. Seriously, don't do it. The real estate sector in the UK was very sensitive to market changes, so I had to sell most of my UK stocks in that sector. I realized that one of the biggest mistakes that made me hold on to the stocks for a very long time was that I had an in-country bias. In-country bias is a tendency to favor investments in your home country over foreign countries. It's a very common thing for investors. It's a very common behavior when it comes to investing. And it happens because people feel more comfortable investing in things that they know and understand. This bias can lead to missed investment opportunities in other countries. It can also increase the risk because you are putting all your eggs in one country or one basket. Okay, so I hope you're all doing well today and you're having a fantastic time watching my video. I wanted to take a quick moment to basically share with you an exciting news. I hope that this year I reach 1,000 subscribers on my channel. So if you haven't already, please make sure that you hit that bell notification and subscribe to my channel. Trust me, you won't be disappointed, you won't regret it. You'll get to see some of my hilarious and informative content and my charming personality as well. I may be terrible at dancing, but I can demonstrate that to you. During the pandemic, my Twitter was going through the roof. I swear my notification overheated my Android phone. Everyone was excited. Everyone was promoting the next hottest thing, and it was extremely painful, like just watching my screen flicker, and it was non-stop. SPAC was one of the hottest things that was on the block, and it was really tempting, by the way. But I literally pulled out. I pulled my plug from my computer and I smashed my phone. I know it was a bit dramatic, but I had to do it. IPO process was created to reduce some of the risks for investors from buying speculative companies with bad financial reports. Do you remember this guy, Adam Newman? I'm sure most of you remember him. There's no doubt you will remember him.
Adam, I've talked to a lot of people who founded co-working spaces. Not all of them do very well necessarily. You guys raised 360 million, I think, in total so far. Your valuation is, you're not really talking about it, but 5 billion or something around that number.
Yeah, that's what was advertised.
That's pretty unusual.
WeWork was one of the most up-and-coming companies that offered flexible shared office spaces for business and entrepreneurs. Well, so we thought. In reality, the company had huge losses and it was in a lot of debt with questionable leadership. When it came to going public, potential investors were concerned about the company's conduct and financial practices. The CEO, Adam Newman, was accused of self-dealing and conflicts of interest, which added the unease for potential investors. And well, without investors' money, WeWork had no choice but to cancel their IPO. This resulted in a drop in valuation and a major restructuring for the company. Adam Newman was forced to resign, of course, as CEO, but not after pocketing $1.7 billion from SoftBank. After failed attempts to go public in 2021, the company went through the special acquisition channel to be acquired by Boex Acquisition Corp, who then took WeWork public.
How long will you hold on to WeWork shares?
I see this as a long-term play, Deidre. If you look at companies that could one day be worth $100 billion, we see WeWork as that kind of company. You need a gigantic TAM, you need a fantastic team, and you need a moat. And WeWork has all of those. It's really a platform play, and I see this as a long-term hold.
2 years ago, the value of WeWork was zero. Company was on the verge of bankruptcy. Company had run out of cash, and the fact that we've taken from zero to a valuation circa $8-9 billion in 2 years is great. Now the future is bright. Like Sandeep has said, I'm just going to give you one data that you realize the power of WeWork. Second quarter, WeWork is less than 1% of all of London commercial real estate office space. We amounted for 37% of the leases. So that tells you that the future is bright. That tells you that people want a flexible workspace.
And even after the SPAC merger was successful, in the third quarter of 2021, the IPO valuation tanked from $47 billion to $9 billion. Can you imagine that? Today it's even trading less than it used to be, 50 cents, with a market capitalization of $321 million. Not billion, but million. So what exactly have we learned throughout all of this endeavor? Well, you have to be ready to invest when the market drops. It's a good idea to keep at least 30% of your cash in your portfolio. Don't also let your personal preferences tempt you into making bad decisions either. That's pretty much it. Just make sure you like, subscribe, hit that bell notification so that you do not miss any updates. I would like to thank you all for watching my video, and please keep investing and let that money run in the market.